Hi, I'm Amir Reza. This is Finotiva. And today I want to show you one of the nastiest financial tricks most people don't see coming. How inflation quietly makes most people poorer while the wealthy often get richer. Stay with me, I'll show you exactly how it works, what to fix first in your own finances, and concrete steps you can start today. Let's rewind. Back in August 1971, President Richard Nixon ended the link between the dollar and gold. That decision changed money forever. The United States moved from gold backed money to fiat money, backed only by government trust. From that point, central banks could expand money supply much more easily. And over time, that meant inflation. When more money flows into the economy, prices rise. Groceries, housing, cars, education all went up. But here's the twist: financial assets like stocks soared even faster. So ordinary savers holding cash got squeezed, while investors holding assets got richer. Think about this. If your salary stays the same but prices rise, you're effectively getting a pay cut. For decades, wages for the middle class haven't kept up with rising costs. But market, they've delivered massive growth to people who were invested. That's the wealth divide inflation quietly creates. Let's zoom in on the last 5 years. From 2020 to 2025, inflation surged. Consumer prices jumped. Meanwhile, median incomes didn't always keep pace. But the stock markets, for example, the S&P 500 in particular, performed strongly. Once again, asset owners pulled ahead, while wage earners fell behind. Here's the cycle in plain English. Number one, governments print or borrow more money. Number two, more money chases goods. Prices rise. And number three, assets like stocks and real estate rise even faster. And number four, owners of assets win, holders of cash lose. Simple but powerful. So, what can you do? You really only have three choices: deny it, hope inflation goes away, not smart, rage at it, get angry, feels good, solves nothing, or learn and act, play the game the way the wealthy do. That's choice I want for you. Step 1: before chasing investments, secure the basics. Pay off high interest debt, build an emergency fund, automate your saving. If you don't, any gains you make can vanish the moment life throws a curveball. Step 2: move some of your money into appreciating assets. Two simple approach. A. Passive investing, index funds and ETFs. Dollar cost averaging. I call it ABB. Always be buying. Always be buying. Active investing, picking stocks or sectors. Higher risk, more effort. Most people do best with passive. Here's a simple formula: spend no more than 75% of your income. Invest at least 50%, save at least 10%. That balance gives you breathing room while building wealth. Here's how powerful consistency is. Investing just $5 per day in a broad market fund over decades could grow into hundreds of thousands. That's compounding. That's why the wealthy stay wealthy. Here's your starter plan for the next months. Week 1: list debts. Pay down the highest interest one. Week 2, build a small emergency buffer. Week 3, open a brokerage account. Automate 50%. And week 4, spend a 30-minute learning market basics. Simple, repeatable, life-changing. Look, inflation isn't your fault. It's how the system is built. But you can decide whether you are on a losing end or if you use the system to your advantage. You don't need to be rich already. You need discipline, a plan, and a time. If you found this useful, hit subscribe, tap bell, and comment right now. Which step are you starting first? Paying debt, saving cash, or investing? I'm Amir Reza. This is Finotiva. See you next video.